The Cancer Eating America: How a Structural Deficit Slowly Rewrites an Economy. Flint West reporting. Summary statement. A structural deficit does more than accumulate debt. Left unchecked, it begins to reshape capital markets, monetary policy, trade policy, and the wider economy around its own survival. Section 1. Every disease has a beginning. Cancer doesn't kill the host overnight. It starts small. A handful of cells that stop obeying the rules. They consume more resources than they contribute. They grow without discipline, and slowly, almost imperceptibly, they force the healthy body to reorganize itself around their continued existence. That is exactly what I believe is happening to the United States fiscal deficit. A government is supposed to finance the overwhelming majority of its spending through taxation. Borrowing has always had a place. Wars, recessions, natural disasters, national emergencies, temporary problems, temporary borrowing. But America crossed that line a long time ago. Today, the United States collects roughly $5 trillion a year in tax revenue, while running an annual deficit of approximately $2 trillion. Read that again. $5 trillion comes in, $7 trillion goes out. That isn't a budgeting problem anymore. That's a business model. And business models don't disappear after one election cycle. They become structural. That changes everything. Because once a deficit becomes structural, it has to be financed every single year. The Treasury has no choice but to return to the bond market over and over and over again. Issue more debt, refinance old debt, pay interest on existing debt, then issue even more debt. At first glance, that doesn't seem particularly dramatic, until you realize what Treasury bonds actually are. They aren't just another financial asset. They are the foundation of the entire financial system. They establish what economists call the risk-free rate, the benchmark from which almost every other investment on Earth is priced. Now think about what happens when government borrowing keeps expanding. The market doesn't absorb unlimited debt for free. Investors demand compensation, higher yields, higher borrowing costs, a higher baseline cost of capital. And that changes the equation for everybody. Every company, every entrepreneur, every infrastructure project, every factory, every power station, every semiconductor plant, every data center, every investment now has to clear a higher hurdle before it deserves funding. And here's where the story gets interesting, because America isn't entering an ordinary investment cycle. It is entering what could become the largest infrastructure build-out of the 21st century. Artificial intelligence, not software, infrastructure, data centers, semiconductor fabrication plants, power generation, grid expansion, cooling systems, fiber networks, hundreds of billions of dollars, possibly trillions of long-term capital expenditure. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 2. Now, I'm not suggesting that AI investors are choosing between buying NVIDIA and buying a treasury bond. That's not the point. The point is that every investment in the economy is priced relative to the government's own cost of borrowing. Raise the baseline, and everything else becomes more expensive. That is how a structural deficit begins changing the economy. Not by consuming all the capital, but by changing the price of capital itself. And once you change the price of capital, you change behavior. But the disease doesn't stop there. It begins spreading into policy itself. Persistent deficits create one overwhelming incentive: find more revenue, anywhere, everywhere, which brings us to tariffs. The current administration is considering broad Hamiltonian tariffs on imported goods. Most people immediately frame that discussion around geopolitics, China, national security, supply chains, domestic manufacturing. Those are all perfectly legitimate reasons. But there's another consequence. Tariffs also generate government revenue. Now, I'm not arguing that revenue is the only motivation. Far from it. I'm saying that once deficits become structural, every new source of revenue suddenly becomes far more attractive than it otherwise would have been. And that is how a deficit slowly begins influencing decisions far beyond the Treasury. Trade policy, industrial policy, capital markets, monetary policy. One by one, they begin bending around the same gravitational force. Economists have a name for this: fiscal dominance. the point where government financing requirements begin exerting increasing influence over the rest of the economy. And that's why I use the cancer analogy. Not because every dollar of government spending is destructive, not because deficits automatically destroy nations. That's not the argument. The argument is behavioral. Cancer changes the behavior of the host, and structural deficits do exactly the same thing. They slowly alter incentives, they redirect resources, they influence institutions, they reshape policy. Eventually, the economy is no longer adapting to maximize productivity. It is adapting to accommodate the financing requirements of the state. That's a completely different operating system. And that's the real danger. The danger isn't simply that America's debt keeps getting bigger. The danger is that the entire economic organism gradually reorganizes itself around sustaining that debt. Because once the economy starts serving the balance sheet instead of the balance sheet serving the economy, the disease is no longer confined to the Treasury. It has entered the bloodstream. I'm Flint West, and that's your macro vibe check.